Let's have a little family chat here, friends. JDew from the Cash Compound. Going to the mailbag. I had an interesting conversation via some Facebook groups and pages that we control or are just members of, and I think we should dive into this conversation I had.
You are now tuned to the banking bros. Said we couldn't make it.
In this particular scenario, ladies and gentlemen, I have to, of course, #protect the wealthy, so I won't be telling you the details of this person, but I'm a part of a few Facebook groups, and of course, I run around here the Infinite Bankers page. So if you want to be a part of what we're doing or see the community of what's going on in the code cracking cash flow culture, you're going to want to join Infinite Bankers. We will drop a link below our YouTube here in the description, and you can join the conversation as well. So let's go in here and dive into what this guy said in particular. At the culmination of a couple of back and forths, he said to me, hey, can we run both scenarios out with real numbers, factoring in an agreed upon reasonable investment return and starting capital over maybe 5, 10, and 20-year results? If you're new here, this won't make very much sense, but what we're talking about is comparing the idea of an investment strategy. That's what this guy was talking about, and what the infinite banking concept would do internally inside of a policy. When we're talking about that policy, we'll get more specific on what type and what style it is here in a minute. But first off, we've got to throw a red flag and remind you that investment strategies and infinite banking are not the same thing at all. And if you tried to combine them together through a comparison chart, you're going to be sorely confused. So we have to make sure that you know where you are before we can get you to higher ground. When we're talking about the infinite banking concept, we are going to solve the banking function in our life. And first off, we're going to remove the need to have third-party interest take control of all of our money. That means over the course of time, the numbers that we're working with are not going to leave our family and go out to third-party banks or finance companies. And then we'll have control, liquidity, and guarantees on the inside, which we can use for investments. Okay, let's go to the original statement that this person made in a Facebook group that I'm a part of. Here it is, 3 days ago. I've always been taught term is best insurance. I see a lot of people reference on here about structuring the policy properly, end quote. I'm not really sure what that means. Hopefully this isn't overstepping, but is there anyone on here who has a good IB policy and would be willing to show by example what that looks like? Thanks in advance. Okay, so I decided to reach out to this person. I saw it when it was fresh, so I commented and hey, we got into this great conversation on Facebook. First off, I want to point out some small semantics around a structured policy in the IB world. That's exactly what he said, IB, those two letters. But of course, we are talking about the infinite banking concept. So sometimes, ladies and gents, just to be helpful and to give you this reminder, infinite banking and infinite banking concept might be separate things. So if you have not actually been able to dive into Nelson Nash's 5th edition here of Becoming Your Own Banker, BYOB, you might be dropping off the C. Infinite banking concept is what is the registered trademark, and that's what Nelson details inside this book. If you drop off that C, you might be dropping off more than you think. And when other people expand on what infinite banking is or could be because they take that definition and broaden it to apply to other areas of life or other products or different structuring of those products, you might get lost. So several great people responded to this guy here. And some people that I know inside the practitioner world, authorized people who do the infinite banking concept, and some people just gave their general good advice. Remember, the ideal asset is an infinite banking policy structured from a whole life chassis. Whole life, WHOLE, is not a universal chassis. It's not a term chassis. It's not a CD. It's not a bank account. It is a guaranteed to grow and cash flowing policy contract from a, number 2, mutual insurance company that pays dividends. We want to participate in the growth of this company as a partner because at the end of the year, when they determine their profits from claims that didn't have to come through because not everybody died, not all of the buildings burned down, and all the cars didn't crash, they're going to have profits. They're going to have a general fund portfolio return, and some of that profit gets returned to policy owners in the whole life category. We are going to participate in the growth of our policy, our growth of this company with a whole life contract. So those are number one and number two. Number three is we're going to properly design it. What does it mean to engineer, properly design, or structure the policy correctly? What that means is there are riders. When you have car insurance, we always use that scenario. Mine might have towing, yours might have liability, I might have comprehensive, you may have OnStar, I may have AAA. There are different pieces of the puzzle, and we're going to pull the levers that allow for cash value. That is going to be liquid equity from the amount of money we bought from the insurance company. Remember, your premium is your cost, is your fee. It buys death benefit. We're going to structure that policy with riders that allow some of that death benefit that we bought that will come to our families one day into equity now, right away. And if we do that, that's what we mean by properly structured. We have other videos on that. That's not the point here. I just wanted to go through this and help you understand that if we start from the wrong place, we're going to run the wrong race. And if we ask smart questions, we'll get smart answers. If we ask stupid questions, we might get stupid answers. So here are a couple of things in the ideal asset that are going to go on. This person is trying to figure out a very simple question. What's going to have a better return? What will I have more money on down the road? And that's not the question that infinite banking answers. Infinite banking answers, how do we solve the banking problem? Because nobody recognizes it. The banking problem says you've got interest going out to third parties from your cars, from your houses, from your student loans, and when you pay cash, you're losing the gains you could have made. You could have kept, might be a better way to put it. You could have kept those dollars inside your own personal economy, and you'll get a separate pool of interest gaining, income tax-free liquidity from your cash value. That's what we're here to talk about. So I had to remind this guy that we've got control, liquidity, privacy, guarantees, tax-free use of the cash value. We have an automatic legacy play, of course, with death benefit, and we've got a high savings rate inside this environment. Nobody wants to talk about that because they think it's an investment tool, and they don't realize that it's the place I put my dollars when I earn them. That's what we're talking about. If you could put your dollars in a place when you earn them instead of a conventional banking arena, and you put it in a place with all of these features, then you'd have more money to be able to invest. In the first couple of years, there is going to be a cash crunch of starting a policy and getting this banking business going, and that normally throws people off and go, well, hey, I'll get better returns in third-party places. And I go, of course you will. They're investments. If those investments work out. But you may not have control, guarantees, liquidity. You may not have privacy. You may not have tax-free use of those dollars. They may be locked up. And so when you do that and you play that game, you've got to realize we're in two different ballparks here. So let me respond to with something that he said. Well, right. I'm not certainly arguing that banking isn't profitable. It's probably the most profitable industry on earth, honestly. I'm more just looking to compare apples to apples and see what individual comes out on top financially using each one of the two schools of thought regarding whole and term. So, of course, this person is doing the whole is too expensive mindset, and term, invest the rest, term, invest the difference is the better idea. So as you can see, we're playing in two different fields. Hey, I want to compare apples to apples. I want to compare an investment strategy that I'll make up or come up with. And honestly, that's mostly having to do with mutual fund average returns historically, or S&P 500 or other index returns over time. And of course, I'm saying that, so that's not what we're talking about here. We're talking about how profitable it is to be the bank. If you are the bank could certainly put their money in any of those vehicles for potential returns. But if you are the bank, look what happens. These dollars inside this policy growing are not there for you or underneath your control if you put them in third-party places. If you do keep your dollars, ladies and gentlemen, we're here to tell you that if you learn to pay yourself in the first place in the right place in the first place, then you have all of these other things added on top of it. That's what we're here to talk about. And my friend here didn't quite get that. He didn't quite get that. Another thing that he said was, yeah, I get investment risk exists in any investing scenario, but even factoring in investment risk, it's reasonably predictable over a long time frame, which is what I'm considering for myself. And I'm trying to help him understand that's not the game. We cannot compare apples to apples. Your money has to come from a pool. And I'm talking about where the investment money came from. What pool? If it's coming from liquid cash value, increasing over time, whether or not you lose it, whether or not you use it, whether or not you invest it, it's still there. And if you decide to invest from that pool, you are going to win every time. Nelson talks about that in detail with an investment strategy that's really brief inside this book. And why is it so brief and so small in all of our 96 pages, I believe we've got here? 92 pages is because this is not a comparison at all of investment returns. So good luck to this person out here. We tried out here, and hopefully over time he starts to understand. We're not saying you should not invest. We're saying, what pool does your investment money come from? And if you understand that scenario, you're going to become your own banker in a big, big way just by not losing the money you normally lose to financing. Appreciate you guys being with us here today. Follow us for another walkthrough, talk through, and in the mailbag today, we're reminded that everybody needs a chance to understand what's really going on. If you do, you'll know what to do.
You are now tuned to the banking bros. Said we couldn't make it, drink or settle, this the life we chose. Gave a lot of game, we never got a lot of things. Bow your head and say the prayer, we taught you how to be the bank.